Hot mic.
All right. We are hot and live. Hey guys, how's everybody doing out there? Welcome, welcome.
Hello.
Hello.
How's it going?
It's March now.
Oh my goodness.
Yeah, 1 year ago we were in shambles.
Yes. Yeah, I guess lockdown was happening like exactly a year ago.
Yeah,
Pretty
the market
crazy.
was panicking. Everybody was selling all of their stocks.
So the question is all of the smart people that were buying into the March panic, are they going to sell now that we're coming after the year?
That is a great question. I've actually had that question a lot lately. Like some people are worried about like starting like a market panic. I don't necessarily believe that theory for a couple of reasons. One, we didn't see that like after 2009 when we had the recovery from the great financial crisis. There was a significant amount of people that were in profit by like 2010, 2011.
Yeah.
And tax selling really didn't create like a sell-off back then. There were some sell-offs during that period, but it was mostly related to like the European debt crisis. But I've never actually seen a sell-off because of like tax, like a mass amount of people selling because of taxes.
Yeah.
Like I don't think I've ever seen that.
Yeah, that makes sense.
Yeah.
I mean, some smart people that bought the lows will probably take some profit.
Oh, yeah.
But yeah,
I plan
as
to
a
take,
whole, like,
I plan to take quite a bit of profit.
yeah.
On my long-term positions that are now hitting my long-term cap gains, like 12-month period.
Yeah.
But okay, I'll say this. I don't think it'll have a massive impact on the overall market, but if there's a lot of other selling pressure coming from other reasons or other factors in the market, then that could definitely contribute. And especially with certain stocks, like certain momentum stocks that are up a lot, I could definitely see that like contributing to some short-term declines.
Yeah. Awesome. Well, let's go ahead and jump right into it. Hey guys, we are live. Welcome, welcome. Man, actually quite a bit to talk about today. If we just jump in and kind of look at the broad markets, I guess we can start just by giving context to where we are right now. You know, Bitcoin had some pretty deep pullbacks over the last week. We're retesting prior resistance at basically 40K. That's now turned support. We've got, DeFi and a lot of the kind of the hot market sectors of crypto that have gotten beat. And then over the past couple of days, we've seen a little bit of a bounce. Where are we at in the Nasdaq? So Nasdaq last week, we had a sell off and a bounce. So it seems like we are kind of back in some kind of rhythm where crypto and stocks are in somewhat sync, which isn't necessarily a great thing, but it's not terrible either. What do you guys make of where we are?
The Nasdaq actually last week, it looked like we were going to break a key support level, and saved by support, it ended up holding up and bouncing back. So I would say that as far as the broad market goes with the Nasdaq and the S&P 500, I would say they're holding up really well in the face of rising bond yields, which has kind of, last week that was a lot of the reason why we had some shaky markets.
Yeah.
I think Bitcoin and the broad markets all could have used a little bit of a correction. I think this is all healthy movement. I don't see anything alarming in terms of broad market structure and the technical structure of it all. So yeah, I think from here, the fact that they're in tandem, I mean, that happens, that comes and goes, right?
Yeah.
So
yeah, I mean, we talked, I think last week we talked about how the markets were just way overheated on several levels. Crypto, the whole NFT and DeFi thing was just getting out of hand. And anytime the market sentiment just shifts so extreme, there needs to be a pullback. The chasers need to get punished.
I think that the long-term bulls should be welcoming this.
Yeah.
The Bitcoin bulls specifically.
Yeah, absolutely. I mean, so far, looking at the on-chain data, and we can talk about some of that, but fundamentals-wise, there are some bearish signals, but I think there's more bullish signals, and I haven't seen anything yet that's like, holy shit, you got to get out, sell everything. Like, it's just, kind of slow and steady right now.
Yeah, well, the inflation, issue is still, we're still looking at that. And I imagine that a lot of people are going to want to hold Bitcoin through that.
Yeah.
Right? Digital gold.
Absolutely.
So,
I mean, that is kind of the topic of today is, will inflation rattle the markets?
Will it
Trav,
ruin everything?
tell us exactly what's going to happen with inflation over the next 50 years.
We're doomed.
Eventually we all are. But in the short term, can we make money from this?
Yes, absolutely we can. Yeah, I think we talked about the inflation risk a good amount last week, and I think in some prior episodes. But yeah, I mean, I think yields, they had a very rapid rise. 5-year, 10-year, 20, 30-year government bond yields rose really quickly, 20 basis points a week over the last couple of weeks. And that spooked markets because, that's a pretty fast repricing of inflation expectations. And the market doesn't like to be surprised like that. And it also has, it has implications for other asset classes, commodities, equities, etc. So yeah, I mean, what you would expect happened. Nasdaq, which is full of the high growth momentum stocks that have been up the most of the last couple of years, that sold off the hardest. It was down about 5% last week. And that really makes sense because high multiple growth stocks that don't pay cash flows are going to look a lot worse when your assets like bonds and corporate bonds and government bonds start paying higher yields. So yeah, I mean, I think what I expect to happen is I don't see a scenario of like this going to 5 or 10% yields over the next 6 months, because the Fed can still step in and buy bonds if it needs to and control the curve. But I think we're finally back, if you zoom out on the chart, to levels that make a lot more sense relative to the actual levels of inflation. Like the Fed is targeting 2% inflation, so bond yields shouldn't be at 0% on the 10-year.
Yeah.
Like you said, if you zoom out and look at the longer term charts of some of the longer term bonds, there's a lot of room to go to get back to normal, to get back to where we were, pre-crisis. And it's not that crazy to think that that's, going to happen. But
yeah, taking a look here at the 10-year yield over the last 30, 40 years or so, you can see, I mean, it's just been really in just a steady downtrend. I mean, this is probably the longest downtrend I've ever seen in a chart.
Oh yeah.
What's even more interesting is putting the S&P 500 layering over the yield chart, and they're just completely inverted.
Yeah.
And there's been a lot of talk about concern about what's going to happen with the markets short term as yields rise, and our equities doomed, going forward kind of narrative. And it's really hard to kind of decipher it all, because long term bonds have just been going down, even as they've had moments of spiking and increasing, like 2018 and some prior times where we've seen rates kind of increase. as those rates were increasing during those times, the general trend has been lower with yields, and the market has been able to just completely sustain throughout those moments of yields spiking. So it's kind of hard to say, at least from my viewpoint, like what this is really going to do for equities going forward. Are we going to be able to see equities stay afloat even if yields do increase a little bit, just because of the overall trends?
I guess with all the helicopter money, why do assets need to come down at all?
Well, that's the difference, though. That is a key difference going into this next, leg. Is not only have we had a lot of stimulus and we've seen the actual consumer on a general level improve their personal finances, but now we're talking about even more money coming in with more stimulus, $1,400 checks potentially for adults plus dependents. So there's families that could potentially, if this passes, come into even more money. And so that is definitely a key differentiator that I would say, the overall trend, we haven't quite seen that. We haven't quite seen that type of money or this type of situation.
Here's what we want to see in stocks. I'll tell you right now what the broad market wants to see. It's fine with bond yields rising to 2%. What it needs to see is a steady rise and then a steady leveling off. What it doesn't want to see is a fast spike that continues and then starts to push inflation expectations so high that the Fed is forced to actually raise rates at a time when it doesn't want to raise rates.
Gotcha. So basically, if we get like a spike like this that basically breaks this multi-decade downtrend where, say, rates shoot up, on the 10-year to over like 4, 5, 6%, that would spook people and probably, cause just a reflexive like sell-off, right?
Yeah, that would cause a pretty severe sell-off in my opinion. So what the market wants to see is like a steady rise in rates and then a leveling off. And if it levels off around the level of inflation that the Fed is targeting, that'd be fine. But I am of the mind that CPI may print above where the Fed wants it to this year because of what you were just saying. Like all this extra stimulus plus the reflation and reopening plus the increase in commodity inputs that we've talked about over the last few weeks that's already happened, like lumber and copper and stuff like that.
Yep.
So if it prints 4% CPI this year, I mean, this is something we need to watch really closely because people may get concerned about inflation and start behaving in ways that actually generate more inflation. And so then it becomes a self-perpetuating cycle. So that's the scenario we want to try to avoid for stocks. And it's TBD. We don't know yet.
So everybody needs to just chill out. Don't go crazy. Don't go buying everything up and hoarding everything.
Yeah.
Let's keep inflation steady.
What I'm hoping happens is that a lot of this excess savings pours back into the service sector economy rather than into like goods as much. There is going to be obviously some buying of goods continuing, but like if this moves more into experiences and travel and concerts and dining out, then that should be okay.
And I think that that's very likely. And that is the sector that basically has seen the most loss of jobs. And still they haven't fully recovered those lost jobs. So I do see that as a pretty likely scenario.
Yeah, man. People want to get out there and eat and travel and have experiences again. I know we've all just been just tied up for a full year now. So it's like a counter peg just ready to go boom.
For sure. For sure.
Yeah. Cool. Yeah. I mean, we can take a look here too at the curve where basically we got inverted about a year ago, right during the coronavirus fears when the sell-off was happening. If you guys remember, it was like the headline was, "Oh my God, the yield curve just inverted.
Equities are gonna crash.
It's doomed." Which maybe it would have been had the Fed not stepped in and printed all these trillions. I guess the question is what happens when that stops, right? Does the music end and somebody gets the chair pulled out from under them?
Yeah, I mean, there's a lot of talk about how the Fed has themselves. I mean, they have themselves in a situation here that they may not be able to get out of, essentially, which I'm not. That's like above my pay grade, getting into all that macro and what, the Fed. Travis can speak much better about that, but I have, heard that narrative that like they've locked themselves in or, pushed themselves into a corner.
Who's going to be the politician to stop spending is the question. Nobody is going to do that.
No. Every single piece of evidence we have right now suggests that we are still going to be in a heavy fiscal spending mode, if not higher than before, given the agenda items on
Oh yeah, the
Democrats.
projections are high.
Cool. So buy Bitcoin. Okay, show over. See you guys.
Bitcoin fixes this.
Yes.
The Fed still has a lot of capability, but it fiscal is the side that really I think is going to be interesting to watch over the next year or two to see what can get done from a policy perspective.
Yeah.
Yeah, and I was reading the last stimulus bill or parts of it to kind of get the overview of the main important things, and I was pretty flabbergasted to think about some of the cash that's coming into some of these families' pockets and just the overall spending, you know, across everything. It's a lot of money.
Yeah.
And
like what would like a family of 4 or 5 get?
a family of 4 with this new stimulus round would get $1,400 per adult and then $1,400 per dependent. Now, this, of course, is all, we don't know what's going to get passed. It passed the House, but obviously we have the Senate to deal with. So we don't know. But that's what's in the bill. And that's, I think, up to $5,600 for a family on top of stimulus that they've already gotten previously.
Yeah.
So there are a lot of families that are going to be coming into some serious money, not necessarily families that needed it too, right?
It's hard to figure out who actually does.
Right, and that's
you
the
don't
problem.
know.
And I'm all for, you know, families during these times that need it getting the money that they need for sure. And but the fact of the matter is a lot of families didn't lose, you know, jobs. They didn't, you know, they were able to be fine.
Yeah.
And they're going to come into some serious cash. But just seeing the amount of spending that's going to happen, not only with this stimulus bill and then later in the year with the agenda, infrastructure, etc., it's just it's a lot of money.
Yeah.
And it almost feels like that MMT experiment. Like we're in it. This is it.
Yeah.
Like
whether you want it or not.
Kind of. This
I
is
mean,
it.
that's why I feel really good about owning Bitcoin. Like I know we talk about that all the time, but like when you think about it, the writing's kind of on the wall. Like I'm not calling for an imminent crash of everything, but it's like where else does capital flow?
The issue really is on the financial planning side. I personally don't see how tax rates don't go up, even for everybody.
Yeah.
I mean, even for people making under 400,000. That's kind of, and I wish I would have pulled up an image of this, but after World War II, you know, tax rates spiked. Basically, after just very high spending, we see tax rates increase. So I don't really know how that's going to shake out, but I am expecting, you know, in the next 10, 15 years, we could be looking at a lot higher tax rates.
Yeah. I mean, maybe even sooner than that. And I know you wanted to pull this up. So this is, what is this? This is...
this is basically the main point is many consumers, not all of them. I know that there are a lot of people still struggling with this, and there are provisions in the bill to help with that. But overall, the consumer has been able to save more. The savings rate is still extremely elevated. The net worth is up. The consumer net worth is up. The debt that the consumer has decreased in relation to their disposable income. Mm-hmm. Personal income is up. You know, basically the consumer is doing okay going into, generally speaking, going into 2021 and into this recovery.
It's kind of like 55% of Americans that own stocks. They're doing better, probably.
Right,
they have white collar jobs. They didn't suffer through COVID as bad. If anything, their day-to-day may have improved a little bit. Their paper assets went up. They're feeling the wealth effect.
Yeah.
They're going to be the ones that are like, as soon as things open up, let's take a first class flight, or let's take the family to Disney World or something. Let's actually spend a bunch of money, since we on paper have more. But then you got the other half of the world or the nation that is still suffering, and that's a very strange place to be.
It really is. And we know that the unemployment rate is lower for those that have college degrees and higher for those that don't, right? Yeah. We know that. And in the stimulus bill, they're talking about boosting unemployment back to that $400 a week bonus, which is what it was back in March of last, or, you know, right after everything hit last year. So that's going to help those people specifically that have lost those jobs. But generally speaking, the consumer's doing pretty darn well right now. It's kind of crazy.
Awesome. Well, let's just keep on trucking, you know? One thing I wanted to talk about is kind of like the longer term picture of Bitcoin in relation to inflation expectations, and like, what does this look like in a world where, let's kind of think through some scenarios. Rates go up, people kind of get caught off guard by inflation a little bit, where, you know, the narrative has been 0% interest rates forever, no inflation, we're fighting, you know, deflation, which is still a very real possibility too. But like, in a world where prices and rates continue to go up and the government keeps spending money, what does that look like for Bitcoin and crypto assets and the competing assets in general? In my opinion, it doesn't change anything on the longer term spectrum. I think, you know, Bitcoin just doesn't care that much. It's going to keep doing the stock to flow fractal waves until something materially changes with that. But I don't see any evidence that suggests that we're going to deviate from that yet. It could happen, but I'm just like, I don't know, man. I don't see anything that could really flop that right now. What do you guys think?
Interesting to look at, you know, people often refer to Bitcoin as digital gold. Obviously, it's not just digital gold, but that is at least one mental model of it.
Yeah.
And gold right now is performing fairly poorly. And it's interesting because, you know, a lot of people see gold as an inflation hedge. So if you're expecting higher inflation later this year, next year, you would think, well, gold should be going up.
Yeah.
But it's not. It's going down. So why is that? Well, turns out, you know, gold is very negatively correlated to real interest rates, which means the rate of or your bond yields minus the rate of inflation. So when you look at real rates, because of the bond yield increases over the past couple of weeks, have actually been rising for the first time in a while. Like, real rates are finally rising again for the first time in over a year. So real rates rising, again, gold negatively correlated to real rates typically. So that means gold's coming down.
Yeah.
So if you think of Bitcoin as a digital gold, you might expect there could be a little bit of pressure on Bitcoin if real rates keep rising. Now, I'm not convinced that real rates are going to rise that significantly. I think that's something that the Fed probably doesn't want to happen. And real rates are kind of just catching up to probably where they should be at, like around 0 or maybe slightly north of 0. So real rates being negative is what we've been in for like the last 6 or 12 months. So again, I'm not making a call short term on Bitcoin or gold, but interesting to think about how gold is performing versus Bitcoin during all of this. Bitcoin's actually fairly resilient relative to like gold.
Yeah. And I mean, I imagine some of this is gold bugs just realizing the Bitcoin narrative and saying, Peter Schiff, you're actually an idiot. And, you know, Bitcoin is better in so many ways.
Yeah. I think that's a big part of it. Honestly, Bitcoin having some characteristics that make it better than gold in some ways, right? In other ways, gold might have some advantages too, like the physical nature of it and that kind of thing.
And that it's pretty.
That's right.
Yeah, I mean, let's just do a comparison.
Bitcoin.
I don't know. You could put like a hardware wallet around your neck and do that.
A chain with the hardware wallet.
Yeah, exactly. But yeah, I mean, if we just look at, say, you know, from the beginning of the year, compare gold versus Bitcoin. I mean, they're almost inverted. You know, there is some inversion action going on there. So,
yeah, that's interesting.
You know, with gold basically down, you know, just shy of like 20% off the all-time highs. And then from the first of the year, you know, Bitcoin is up or made a local top, you know, at basically a double, you know, over a double. So, yeah, I mean, liquidity is definitely getting sucked out of metals. And I think some of that is coming into the crypto ecosystem.
Yeah. And I mean, we know, and we've talked about over the past year, how Bitcoin is under-owned in investors, especially institutional investors' portfolios. So
yeah,
that's a tailwind that Bitcoin has that gold probably doesn't really have. So that's a kind of thing that can continue to keep Bitcoin afloat. But I could see Bitcoin taking a little bit of a breather here if, you know, it's really experiencing the same thing that gold is, which is a little bit of concern over the rise in real rates. Because again, if you can go get some actual yield now in bonds, then, you know, maybe Bitcoin becomes slightly less attractive than it was at, you know, 0% or negative real rates.
I wanted to ask you guys about this tweet. I thought it was pretty funny. I kind of liked it. Eric Voorhees was saying, it only took 12 years of Bitcoin being the greatest investment in human history before the financial advisors began timidly introducing it to their clients.
Oh,
Nikki, I think you might have an opinion on this.
I saw a comment today amongst other financial advisors that were like, they were trying to have a conversation about Bitcoin, and in the comments it was like, if any of you are recommending Bitcoin to your clients, you're the worst, basically. In
Really?
a nutshell. There are still a lot of advisors that are very anti Bitcoin. It's irresponsible if you even introduce it to a client or put it in a portfolio or whatever. So I would say this has not been even fully adopted at a fraction of the percentage of advisors that could be, putting Bitcoin in.
Okay. I used to understand the argument against Bitcoin, like owning zero of it. Like in the early days, I'm like, yeah, this is so risky. It's so early. Like this could go to zero. I'm a gunslinger, so I'm going in heavy. But nowadays, it's like if you're a financial advisor and you're still beating the drum of like, you better not own any of this and you better not advise any of your clients to own it. Like, what are you even thinking? Like, do you even understand risk adjusted returns and how something like this makes sense?
Well,
like,
I think I think that it's a lot to do with the fundamental aspect of it not fully being understood. And two, the volatility. I mean, it's the most volatile asset you can buy.
Right.
And
but risk adjusted returns, right? It makes sense. Like it have 1 or 2%, right?
That's why a small allocation in a portfolio could really help overall performance. And we've talked about that. We all agree on that.
Yeah.
But there are a lot of people that can't get past the fact that Bitcoin is like came out of thin air and it's worth $50,000 a coin and it's super volatile and it's not even doing anything. Like to them, that's their narrative.
Not even doing anything. I love that. No, it's true.
That's their narrative.
It's true.
You know what I'm saying?
You know what? And I think that's a good time to interject this. I have a buddy. So right now in Myanmar, there's a military coup going on. And, a lot of people that still talk negatively today about Bitcoin, they don't see the real world implications and the things that can happen, right? My buddy called me a few days ago. He's like, look, all my bank accounts are frozen. The banks are shut down. I looked out my window last night and saw somebody get shot. Like bad shit is happening in Myanmar right now. So send him some Bitcoin. And he's like, I got to make payroll. I got to buy food. How do I do this? And he knows Bitcoin. So I sent him some Bitcoin. He has ways to get cash on the ground there. I'm not going to tell everybody what he's doing, but he has ways to get cash that are outside the banking system. And so now he's able to eat and pay employees and actually contribute to the protests. So I think this is so cool. And I think we always, we talk about speculating and investing and stuff, but it's always good to look at the real world use cases for what Bitcoin can actually do. And if anybody's sitting out there going, I don't understand what the value is of Bitcoin, this is it right here.
Yeah.
Us sitting in Western countries and, we have our credit cards with rewards programs and, we're banked. We don't see and feel viscerally the need for Bitcoin. Like people under these repressive regimes, like they need this to survive.
It's amazing.
Yeah, that's a really good example of how it's useful.
And that's why it's eating everything. So I love this chart. So this is a newsletter from Ecoinometrics. You can follow them on Twitter and they have a Substack, but I love the graphics that they put together. You can see, Bitcoin's progress bar across different assets and how it's basically eating the market cap of different markets. So it's now exceeded JP Morgan's cap, Visa's cap, Tesla, I don't know what their market cap is of today, but it basically ate that. Facebook, it's coming for Google, Amazon, Microsoft, and we are less than 10% of physical gold's market cap, which is, call it 10 or 11 trillion bucks, right? So if you have a long-term thesis that Bitcoin is going to catch up with or eat or even far exceed gold's cap, there's a lot of upside potential there. Right?
Yeah.
And obviously it's hard to know what's going to happen multiple years out into the future. And I don't base all of my trades and positions based on these moonshot targets, but it is interesting to see how this just continues to grow.
That puts it into perspective for sure.
Yeah.
Seeing it like that.
Absolutely. And, I think it's okay that a lot of these financial advisors aren't in yet. We need people to buy over the next 10 years to continue to eat up the supply.
I mean, once advisors see institutions kind of getting more involved, and there's easy ways to custody the asset for advisors so that they can get their AUM and then and I think Fidelity and Schwab either already have solutions for that, or they're working on solutions for that. Pretty sure they have them. But yeah, it's just a matter of time, right? Like it took this long just to get the mainstream retail investor to finally buy into it.
Yep.
And now there's this new phase of, the institutions are backing it. Okay, all the advisors are related to the institutions. There are, registered with the institutions. Then they'll start suggesting it to clients or using it in a portfolio to manage, like you said, risk-adjusted returns.
And I think we've covered this before, but I always like to pull up this chart of gold to use as an example to show what happens when you get paper markets. So like in the early 2000s, the gold ETFs came out, and that helped create, a decade bull run, or, so I think we're getting to that point now, right, where we've got these derivatives. You had, Canada that came out with an ETF, and I think that before the next halving, we're going to have multiple ETFs in the U.S.
It's coming.
It's got to be. Yeah, it's got to be.
It's coming. CBOE today, I believe, released something saying that they filed for an ETF, and CBOE is like, a massive derivatives exchange. So it's like.
And I will say, once that happens, I think that the advisors are going to be way more on board, and they're going to be utilizing those securities for sure.
Yeah, because at that point, what career risk does an advisor have, right? It's like,
as long as you don't over allocate.
Yeah, yeah, it's easy. You will. It's going to quickly become uncool to be a Bitcoin bear. I think it's exciting.
I think that for advisors, they should be looking at this as an exciting time. If there is an ETF, a Bitcoin ETF, that's really going to open up a lot of their abilities, because part of it is fear of handling the asset, dealing with it, with the
custody aspect is scary for people that aren't technical,
and it's a lot of responsibility too. So.
But Fidelity's all in, so any financial advisors that are working with them, that's easy.
Yeah, they're doing custody, and I think Schwab too.
Yeah. They all are going to.
A real ETF would be great too, because Grayscale, the way that Grayscale works is a little bit troubling.
Yeah.
And it stinks right now with that, for one, and two, it stinks that you can't invest in Bitcoin and tax deferred other than that. And then you have,
or a crypto IRA, which
probably
very few people actually have.
Right. It's just not super accessible.
Yeah.
In a good way, that you're not paying some type of crazy premium, or, paying expensive fees to have a self-directed IRA, so it's going to definitely be a game changer once an ETF comes.
Absolutely. Couldn't agree more. You guys want to do some Q&A?
Let's do it.
All right. So anybody that's in here live, feel free to post questions in. Last week, we didn't get into any of the submitted questions, so this week we will. Alejandro was asking, he says, I took some big profits from crypto and decided to diversify them into stocks, but I'm worried of buying at the peak. Do you think an actively traded ETF like ARK is a safer bet than stocks at the moment? Do they keep cash on hand to buy big dips? What do you guys think? What do you make of that?
ARK is risky because it's heavily driven by retail flows that are very volatile right now. So we saw last week that ARK was being forced to sell its stock positions because there was assets flowing out of ARK.
Yeah.
Then this week you had assets flowing into ARK early in the week. They had their, I think, second highest inflow on Monday.
And what is ARK for anybody that doesn't know?
ARK Investment Management is a firm that actively manages capital and has ETFs for different themes. Essentially, they have a genomics themed ETF, they have an innovation themed ETF, and they're adding more every few months.
Yeah.
But they've been one of the hottest performing ETFs over the past, or ETF families over the past year, because they have gone basically headfirst into high growth momentum concept stocks. Like, they owned big positions in Tesla. They've made some good calls, but their strategy is very, very risky. And again, those ETFs are just very, because of the extreme flows both in and out, I see them as very risky vehicles. I do not see them as safe places to just park capital to get, a modest market beating return without, having a lot of risk. I see them as high risk, potentially high reward, but very high risk.
Also, 2020 was just the creme de la creme market environment for ARK. What's going to happen when the market environment shifts for them? And a lot of these I call it Momo, but momentum names get, they correct a lot, like we've been seeing. But it also depends on your time frame too. I mean, if you're looking for lower risk than ARK, because like Travis outline, there is risk there.
Yeah, where are you on the risk spectrum?
Yeah,
do you want to go higher risk, higher reward, or do you want like a market average,
market return,
very safe return?
Yeah, and as far as like the S&P 500 or the Nasdaq go, if you have a very long time horizon, then are you buying the peak right now? Nobody knows where the peak is going to be, and in 20 years we could see S&P 500 at 6,000.
That's the constant dilemma as with investors is, okay, prices are up. I don't want to be the greater fool, right? Like, or is this the top? Who knows? That's the existential crisis of investors, is always trying to figure out, am I the greater fool, or am I, in early enough?
That's why time frame matters so much. Like, how long are you going to be holding, And if your goal is to diversify, then an index is helping you diversify. I mean, you're
True.
across all sectors. So
yeah. And I feel like, so this is a very common question that we've seen is, okay, I made a lot of money in crypto. Maybe I've taken profit or I've diversified elsewhere and I'm sitting on a lot of cash. What do I do? Right? That's a very common thing. And by the way, guys, we're not financial advisors, so we can't give you like a personalized answer. We don't know your situation. We don't know your risk tolerance. Our risk tolerance is probably a lot different than yours. So we can give like general answers as to what the options are, but we're not going to tell you specifically what to do. But one thing that I say, to people that's like, they're like, I made a lot of money. I have a lot of cash now. I just want to put it into something. It's like, maybe it's time to pump the brakes. Like when you pull money out and you have cash and you're thinking, okay, I'm going to move money, or I'm going to lose money to inflation over time, so I don't want to sit on too much cash. Well, you could get over aggressive and lose even more by putting it back into bad investments, right?
Right.
So market timing matters. And like what I say is, when Bitcoin prices are cheap, when all the fundamental and on-chain data is showing it's a good buying opportunity, that's the time to accumulate Bitcoin and to actively trade, if you want to accumulate more Bitcoin. When prices are higher, and Bitcoin's gone up roughly 400% over the past 4 months-ish, that doesn't continue forever at that same pace. We need pullbacks, we need consolidation, and when prices are high, you trade to accumulate fiat, so you have even more when prices are lower. It's like it's a machine. It's a compounding machine.
I think a good way to kind of mentally figure this out for people is to think about buckets of risk and buckets of capital, how you want it managed specifically. If you know that like you need 200 grand, that's, just going to get an average market return, and like it's safe. There's risk there, but it's safer than being, in something volatile like ARK or whatever. Have capital buckets of risk that you can know, okay, I have this much money that's invested this way, this much money invested this way, I'm comfortable here. And then maybe throughout the times, you're like, you know what, I want to take on a little bit more risk, and you can, move money into different buckets. Sometimes that helps people kind of figure out how to allocate.
Yeah.
That's the not that's kind of not the professional way to do it, so to speak, but it's a way to it's called mental accounting. It's a way to kind of think of it to make it easier for you to think, this is money I don't want to lose, so I'm going to invest it this way so that I don't lose it, because it'll pay off my house or whatever. So I don't know. That's
why, when I look at the people that are very public about having almost 100% of their wealth in Bitcoin, I'm like, first and foremost, okay, cool. You have a ton of conviction. But somebody that isn't a decamillionaire probably shouldn't do that, right? Like if you're somebody who still has not hit your FIRE number, your early retirement number, where you can live off of 3% of those assets forever. If you haven't hit that, it's probably not a good idea to yeet 100% of your net worth into Bitcoin. I don't know.
Or
That's just my opinion.
Or any asset for that matter.
Any asset. Yeah.
Right? There's such a thing as being too diversified, but there's definitely such a thing as being too concentrated in one asset, and then you lose a significant portion of your net worth for however many years when that asset goes down.
Yeah, and actually, I should have pulled it up, but it's that graph of different years, all the different assets, and the performance over time. And this past year has proven that diversification is really important. Guess what the best performing asset was in 2020?
Bitcoin.
Well, Bitcoin wasn't on the chart.
Yeah.
But Bitcoin.
Outside of
like
our
large caps, small caps.
You're talking about equities specifically. Yeah.
Or bonds, certain bonds, cash,
What was the best performing?
What was the best performing?
Small cap, right?
It was small cap.
Yeah.
But like if you weren't, it was small cap and then.
Yeah, which you never really would have thought would be the winner.
You wouldn't have thought. That's what I'm saying. Every year it's different. And then I think large caps were number 3 on the performance list in 2020.
Yeah.
You wouldn't have thought that. So, I don't know. I just think that it's really important to remember that we diversify for a reason.
Yeah.
Because we don't know what number 1 is going to be every single year.
Mm-hmm. Yeah, and it's difficult for people that are so heavily concentrated in crypto during the bear markets. It's like if you have 100% of your net worth and then you have an 80% drawdown, I don't care who you are, that is going to hurt like hell, unless, again, you're a decamillionaire and it doesn't affect your day to day.
Yeah. I think, as it relates to this question, again, personally, I like having cash at almost any time for optionality and opportunities to buy different things. But there's I wouldn't be consistently at 50% of my portfolio in cash, right?
Yeah.
Like there's a number there that probably swings for me from, 0% cash when it's March 2020 and I'm buying everything in sight, or it's, 20% cash when the market's at parabolic heights.
Yeah.
So, everyone's number is going to be different there, but I find having some amount of cash at any given time is a good thing. And I'm happy to sit for a couple of months with a maybe higher than average cash balance, especially when markets have been ripping, and I want to step back and take a breather and then reevaluate the opportunities until I feel comfortable. You don't want to necessarily be in a situation where you're just trying to pump money back in and not, really feeling comfortable about it, or feeling like maybe you're investing in stuff just because it's going up still, but you're not really feeling good about it.
Yeah.
That's actually something that I've been kind of dealing with over the past month or so is I have built up a cash position, and I've had positions that I've wanted to take, but I haven't felt great about valuation. And I've had to, really 2020 was a whirlwind, and it was like you had to get on the opportunity, right? And the market environment, felt right. Everything just felt right. But I have been finding myself having to kind of revert back and be like, Nikki, stick to your plan.
Yeah.
Stick to your values, and don't just try to jump in. Make sure that when you get into a position, you feel good about it, you're excited about the position, and you're buying at a good value, considering. And so I've had to definitely do that on my end over the past month and kind of check myself before I wreck myself.
That's the thing. Yeah.
Yeah. A lot of stuff that I've been doing lately with that too is just having small starter positions and things where I've given myself a lot of room to make them bigger for when dips happen. So it's like, okay, I want a little bit of an allocation to this idea, but I'm hoping to get a bigger position if it sells off, and maybe it won't, but I've got a little position there and then opportunity to make it bigger. So
yeah,
I like that.
Awesome. Let's do some Q&A from the chat. Let's see the Metro. Chris, I was watching you in 2014 when you switched from stocks to Bitcoin. Emails from you saying it's your new big investment. Thank you for being the person to first show me Bitcoin. Yeah, man, it's crazy looking back at the early days.
You looked crazy back then.
Yeah. Well, a lot of people didn't understand, right? They're like, why are you leaving futures to focus on crypto? The risk is just crazy. But in hindsight, everything's 2020. But at the time, it was like, in the futures market, the the volatility was going down, the competition was increasing, meaning it was getting harder to make money. And then I looked at Bitcoin and I'm like, this just seems ripe for explosion. So yeah, I don't know. It's fun looking back at and we have some early email exchanges talking about that.
Yeah.
And how ignorant we were to so many things. I remember the first time I saw Bitcoin, I'm like, is this a penny stock? What the hell is this thing?
A friend messaged you about it, and you were like, nah, this looks like a scam, or whatever.
Well, and I mean, it was even in the early bubbles in like 2012 and 13, that's when I would get the pings, is when price would go from like $50 to like 200 or something, you know, things like that. And it's like, no, you don't want to buy those local tops, but long term, this is a win. This is massive.
Yeah.
Michael Roberts is asking, Chris, can you guys talk about how the housing market and bond yields might affect the mortgage slash housing market? Yeah, I think that's a good question, right? Because real estate was one of the best performing assets last year too. It was like 10% nominal returns and 9% real returns, I think, which was one of the highest, especially since the housing boom of the early 2000s. So yeah, how do you guys think about real estate if rates start to go up?
It affects different parts of the market differently, right? So on the high end of the market, it has a pretty big effect because rising rates, mortgage rates can affect a lot of what happens, especially with like jumbos and things like that. But on the low end, there's a scarcity of supply in certain areas. So the market will probably continue to be hot, especially if rates level off. You know, if rates do stop the fast rise and they level off and the 30-year mortgage rate goes back to 3.5% or 4%, that's not necessarily going to kill the entire housing market. But it could have an effect on certain markets that are maybe overheated, certain, high-end markets that are overheated. But in areas where there's a scarcity of supply and rates still remain relatively low, then I think, it could continue. There's weird dynamics, though. There's like the whole lumber price increase.
Yeah.
That actually argues for continued scarce supply because it becomes very expensive to build new housing units. So
I know here in Austin, it was weird because with COVID, the supply took a dump. Like people just weren't selling their houses. And at the same time, you had the rush from California coming here, which created a weird imbalance. And then rising costs in lumber and, we have a few friends that are shopping for homes right now and they're getting outbid. It definitely it's not pure speculation though here, which is the weird thing.
Yeah.
It's driven by
Austin specifically?
Yeah, in Texas and Austin specifically, it's like we have a rush of people and falling supply. So here I think we're kind of insulated just because of the population. It's not like Miami in the early 2000s where they were building hundreds of thousands of condos or whatever, and nobody was moving there to fill those buildings, right? So I think maybe what we could see, my guess is we're going to see some markets get demolished and other markets stay flat or do relatively well. Like Austin back in the housing bubble of the early 2000s and 08, if you look at the price charts, they barely had a blip.
Yeah.
Because Texas had regulations from the 80s, after the savings and loans crisis, where it made it harder for lending to get out of control.
Yeah.
And so, I don't know.
I tend to, yeah. Oh, sorry, I cut you
No,
off.
go ahead.
But I tend to completely agree with your views. I don't think you can look at the like U.S. or North American housing markets as like one market. 2007 was a little bit unique, and when we had that, housing market collapse because it did feel like a lot of the markets were moving together, but I see it today much differently. I see it as like a collection of different regional markets where some regions are going to do very well still and other regions, probably have topped out maybe in the short run. Assuming, rates do continue to rise.
Yeah.
Rates do have an effect. They have an effect on the amount of monthly payment for people. And so therefore it can affect, how much people are willing to pay for a home. But on the other hand, we have this pent up savings rate. There are people with, amounts of money now for down payments, and there's, demand there. So you have that kind of offsetting the interest rate impact to some degree.
And you have people that are moving from expensive areas, high cost of living areas, into medium and lower cost of living areas.
Yeah.
So kind of those, secondary and third level cities, I think, are going to see a boom where I'm still net bearish on like San Francisco and stuff like that, where the political scene is just a shit show, and sky high prices. Like people question, oh, why am I living here, right? And that's why we've had the mass flood here from the Bay.
Yeah.
All right. Next question. Nate was saying, hey, Chris, been watching since 2013. I'm in a debate with friends. Do you see the bottom for Bitcoin until the next time all-time high at 40K? My friends say 27K. So unfortunately, my crystal ball is in the shop right now. So I don't exactly know what Bitcoin's going to happen or what it's going to do over the longer term. My kind of sweet spot, what I call my arc of like probability and accuracy, is kind of in the medium term. Right now, we actually have really nice price structure. You can see here, we've got a run after the 40K breakout. Basically had a straight run from 20K to 40K, and then we had a 30% pullback. So run, retracement, and then we had an extension, a run up to just shy of 60K. And then you can see as of like 2 days ago, we had a pullback to retest 40K, which was prior resistance. Now it's turned into support. So one thing that I'm keeping my eye on here is, okay, what happens with price structure around this 40K zone? We're either going to get a bounce for another extension to the upside to kind of maintain this fractal, or this is going to shift. I don't know what's going to happen, but as a trader, I don't try to predict, right? Like I try to think of the possibilities. Like, okay, here's the top 3 to 5 possible outcomes that could happen. And how do I manage my position around all those possible outcomes? So if price holds up, I have a risk management plan and a take profit plan. If price action falls apart and it looks like we're shifting for a deeper pullback, I have a way to manage that as well. So I just think that mental process is much better than trying to go, okay, I think the low's at 40K, but my friends say 27K. Well, you both could be right in a way, and you both could be wrong depending on how price action plays out. So don't try to guess. Just try to come up with a plan that you won't get hurt no matter what happens.
Yeah. The matter of fact or certainty in trying to predict price levels, it just never works out. It's just always better to have a plan for both directions and just let price tell you where it's going to go, because it will.
Yeah, exactly. And it's like you want to think like a chess player or a poker player, not a gambler at the blackjack table that's looking for the drunk guy behind you to tell you if you should hit or not. You know, that's unfortunately how a lot of people approach the markets.
Yeah.
All right, let's see. What other questions? Let's take another one from here. Alex was asking, hey guys, thank you for the weekly show. I always learn something new. I'd appreciate it if you could explain how you approach your research for individual stocks. Like, where do you start and what do you always check? Also, where do you get your information from? Any particular websites? Yeah, this is good. I think this is a great kind of beginner question. Like when you're looking at beginning in the stock market, where do you find ideas? How do you get started?
It's funny because I've literally been teaching this in the last several weeks at the stock boot camp. Like literally
this exact thing,
this exact topic. So we, like, I think, 2 weeks ago we covered idea generation, and then last week we started covering like the initial research process, where I talk about all the tools I use and what metrics I look at, and very, very specific checklist for what I look at when I'm researching.
So do this. Take the 40 hours of training and condense it down into 30 seconds. Go.
Okay, so once you have your ticker idea, okay,
I love Tesla, for example. What do you do?
Where's the first website you go to?
It depends on the stock and the situation, but I think a website like Koifin or Seeking Alpha tend to be very good starting places. Yahoo Finance is another one, although I'm not a huge fan of that site these days.
Yeah.
But those are free sites, while Seeking Alpha has a paid product. But Koifin and sites like that, Ticker, Atom Finance, they do have free features. And what's great about those sites is that you can get a lot of information condensed in one place. So you can get financial metrics, you can get price charts, you can get news and event transcripts, to where you can dive into what's been happening at the company lately.
Yeah, why don't we pull this up, Kev? We'll just pull up the screen share real quick. This is what we're talking about. So Koifin gives you all of that for free as of right now, right? In these snapshots, where these are probably the best types of charts and aggregated data I've ever seen. What do you think? Outside of like a Bloomberg terminal, like this is incredible, huh?
Yeah, I mean, Koyfin, the whole thesis behind their company is that they want to bring the power of a Bloomberg terminal to retail investors and to your average investor. So that is their goal. And I love that goal. So yeah, so we've been using it a lot more lately, and they keep adding features. And like you said, the great thing about it is you can look up like financial statements, you can look up metrics, you can look up earnings estimates, you can look up all these different things. And so as far as what actual metrics I look at, I'm gonna save that for my boot camp. But but I can give you some obvious ones right off the bat. Things like revenue growth rates, gross margin levels. You know, what's the short interest? Has there been recent insider buying? Those are just some of the things you might look at initially. You're also probably going to want to know what's been going on in the business lately. You know, what's the trend in terms of product announcements or major news items? So those are some things that you might look at initially. And how you break that down, obviously, you might want some training there. And if you do, that's why I teach the stock boot camp. But shameless plug there. But yeah, I mean, it's a lot. There's a lot of things that you can look at when it comes to public companies because you have so much data. So filtering out the signal through the noise is exactly the job of an active investor. Yeah.
And that's literally what you've done for almost 2 decades as a professional, you know, from the hedge fund and now managing your own capital. It's interesting to see how much crossover there is there and how like a lot of the stuff you were doing at the fund is still the same stuff you do today, right?
Mm-hmm. Yep. Yeah, I mean, it's the same process with just maybe not as many resources, but
except instead of managing $1 billion, you're managing what, $500 million of your own capital.
I wish.
You'll get there eventually, my man.
Yep, compounding.
Hell yeah. All right, next question, Dave. Hey guys, what are your market top and bottom indicators on the charts? For volume time frames, are you looking at the 5-minute, 15-minute? Ooh, nothing even close to that. But also indicators outside of the charts, like Twitter for possible market tops. Cheers. What are you guys looking at for market top and bottom indicators on stocks? And then I'll do crypto.
Dude, I am all about naked price action for one. I think that there's so much power in price action alone, candlestick charts, and just what it's telling you. I love the daily chart. That's really my go-to. I don't really focus too much on 5, 15 minutes. I think that anything pretty much in between is kind of noise.
Yeah.
I do pay attention to 2-minute charts when I'm like really trying to zoom in on what price is doing short term.
For like entries and exits?
Yeah, like if I'm looking for a top, right, I'll be looking at the price action. I'll be looking at RSI, probably on a daily chart and volume. And then if I think we're rolling over or breaking a key level, and we're changing and shifting momentum, I'll go to my 2-minute, look at what the 2 minutes been doing with price. Are we starting to see, the intraday price action kind of ticking lower and unable to break out through key levels? And I'll zoom in there. But anything pretty much in between there, to me, I don't really pay much attention to be honest.
Yeah. Cool. What about you, Trav?
I just throw darts at a dartboard.
Nice.
I'm just kidding. No. I mean, I'm a fundamentals guy, and I tend to, I will watch price action, and I'll definitely look at price charts, but typically on a much longer time frame to try to see key points where things are happening in the stock. But I don't really focus on minute by minute or hour by hour price changes. Most of that's noise for me as a longer term fundamental guy. So. Yeah, I'm not the person to ask about technical indicators and reading charts.
I also really I use moving averages a ton.
Yeah.
The 200-day, simple, and then I use the exponential moving averages.
Yeah, I think there's a lot of crossover between stocks and crypto. Personally, I think crypto charts are actually easier to read than stocks. For some reason, like must be the capital growth and just the emotional.
It's just that the technical analysis is cleaner.
That's what I mean. Yeah.
Okay.
I like the charts. Like I can see the trends. I can see the reversal areas. Stocks, they can get thrown off, I think, a lot easier by
news,
a news or a tweet, or like one thing could shift one company easier than one thing happening in Bitcoin and completely shifting that. It used to be easier to influence the chart in the early days when there was less capital, smaller market cap, whatever. But nowadays, I mean, the charts are just beautiful. Like, and as far as like market top and bottom indicators, one thing that we actually have here on like Glassnode. So Glassnode is a tool that you can use to find on-chain data and some fundamental data. And they actually have a section dedicated to market tops and bottoms. And, you know, a handful of these are actually really good indicators. And you can backtest this stuff and see that, you know, when things, you know, for example, like the Z-score are at the bottom of the range, those are typically the best times to buy. And when you're up here in the red area, those are typically the best times to take profit. There's several of these indicators. You know, reserve risk is another one. The Puel multiple is another one. So I really focus on these for kind of my multi-year market tops and bottoms, right? And then obviously I'll trade in and out of that. As far as the technicals go, I'm a big fan of using Fibonacci extension tools. And I just keep it really simple with moving averages. I use a 100 period and a 200 period moving average. And then I use price areas, you know, dynamic price structure and fractals. And that's pretty much it. Yeah. I don't use any oscillators like MACD or anything like that anymore. Just keep it simple.
I feel like you and I both have a very simple approach to technical analysis.
Mm-hmm. The more simple, the better. You know?
I agree.
Yeah.
I agree 100%. And people are asking about all these complex indicators. And I'm like, I don't even know what that indicator is. You know, there's so many indicators. But I think that that less is more. Yeah,
when you think about what indicators are and what they do, it's just different ways of quantifying price, right? It's ways of reading moving averages or oscillating momentum or, you know, things like that. And it's like, okay, those can be helpful, but they can also just add conflicting information and create confusion too. So whenever I see somebody send me a chart and they've got 15 different indicators, I'm like, tell me specifically what value each indicator adds to your trading strategy. And most people are like, I don't know. I saw some guy on YouTube using this shit, so I'm just copying him, right? Without knowing how to either backtest that indicator to find is there even an edge there, or like what quantifiable edge does it give you? And 99% of the time, it's nothing. It's noise.
Give me naked candlestick charts and a fib extension and a retracement, and I'm good to go.
Yeah,
pretty much. Like I could probably trade it based on just that alone.
Exactly. Yeah. Cool. All right. Let's do another question. Gabriel, what do you think about Reits?
I think Reits are great. they can be great. I mean,
what are Reits?
Real estate investment trusts. They have some interesting components to them. Like REITs in the US, for instance, are required to pay out 90% or more of their taxable income each year as dividends. And they have certain tax treatment, which enables them to avoid taxes at the corporate level. So that's why a lot of property companies will use the REIT structure. And so REITs became very popular among income investors, people looking for dividends and dividend yields and things like that. And so REITs are interesting, but they also have a lot of leverage. You know, companies essentially create REITs. They buy a bunch of properties. They often lever them with debt, you know, so that they can acquire more properties. They actually use quite a bit of debt capital. And they can be structured all different types of ways. They can have different focus on different sectors within real estate. So you could have office REITs, you could have mall REITs, you could have, you know, cannabis growing facility REITs, you could have
cell phone tower REITs,
cell phone towers, data center REITs. You know, there's lots of residential real estate REITs, and so there's lots of different types of REITs. Really hard to give you an opinion about REITs as an asset class. It's like asking the question, what do you think about stocks? Well, what stocks? When? Where? Why? You know, like. So yeah, I mean, I think we've invested in some REITs historically and done well when you are buying the right assets at the right times. But
yeah, one thing to know about REITs too is right now with the tax law, basically the dividends they qualify for a 20%, it's called a QBI deduction. And it helps reduce your tax liability on the actual dividends themselves if they're in a taxable account. So if that's just something to know. Fun tip. So a lot of people do try to hold them in taxable accounts because of that QBI deduction that you can get on your taxes. And I do know that, you know, a lot of money managers tend to keep allocations to REITs smaller. You know, it's not going to be a huge part of a portfolio.
Yeah.
Let me give you a couple things to think about on REITs generally right now, because a lot of REITs got whacked in the March 2020 sell-off for a few reasons. One, obviously, the leverage on a lot of the REITs' balance sheets was problematic during a financial crisis. Two, a lot of real estate like office REITs and mall REITs are kind of under pressure when it comes to their rent payers. You know, malls saw a lot of their tenants stop paying rent for a couple quarters. Office REITs are thought to have risk because people may be downsizing their offices, and so leasing is getting more difficult for office REITs, you know, in some areas potentially. So there's a lot of interesting dynamics happening with REITs now that maybe we didn't have a few years ago. One other major dynamic is rates are rising, which means these REITs that have to refinance some of their property debt may have to do it at higher rates going forward. You know, they were seeing declining rates on their debt over the last probably decade or so generally. And if you're able to finance a property using 3%, you know, debt, that's great. But what if now you have to refinance that debt at 5% or 6% debt? So that becomes more costly. So there's a lot of changing dynamics with REITs right now. And that is something that you need to actually dig a lot deeper on the specific assets that the REIT holds, its balance sheet, things like that. So there's no way to really give you a broad bullish or bearish type of opinion for me on REITs. I think it's very specific to the specific sector or specific REITs you're looking at.
What I like about REITs is it gives you exposure to real estate without having to go fix toilets.
Yeah,
you know?
That's why a lot of people like it.
Yeah. Like I have a rule that I will not lay a hand on a piece of real estate because when I do, it loses money. I'm terrible at it. I feel like it's one of those things that if you want to be a real estate investor, that better be your profession, because if not, you're going to get screwed by contractors, tenants, smarter investors. You know, there's a lot of sharks in the real estate game. So
True.
Yeah, invest passively in REITs and move on. And you know, the return on your time might be higher than going to one of those get rich quick seminars. And I'm going to go wholesale real estate. I'm going to go, you know, find motivated sellers and flip real estate. Okay, yeah, you and 10,000 other people in your city.
Yeah, that's so true. Yeah.
Cool. All right, let's do a couple more questions and then we will wrap it up here. I saw a couple of questions about Goldman's announcement that they're going to open back up their crypto trading desk. And I saw some people that were posting charts like last time they made the announcement, it was during the 2017 high. And now people are like, oh, is Goldman going to short and are the markets going to crash? I don't think that's a guaranteed outcome. I think Goldman is going to be, well, Trav, what do you tell me what you think? You worked there for a little bit.
Goldman goes where there's opportunity. Goldman doesn't have some nefarious, you know, Goldman just wants to make money. And if they think there's an opportunity to make money trading some assets, they'll go there. If they think there's money to be made by, you know, doing private equity deals and in specific types of assets, they'll do that. You know, like they'll go to funky places. Goldman will go. I remember when they were big into buying up like aircraft and then they were big into buying up like Japanese real estate and golf courses and funky stuff like that for a while. Goldman will go where there's opportunity. So they see crypto now that it's got more interest and more volume than ever. They see it as an opportunity to make money. I don't think that they have some agenda to go and short Bitcoin to try to kill it. That's not what it's about.
Yeah.
They're just like, hey, listen, this is a big market. It's growing. Let's make money. That's it.
Yeah. They'll be opportunistic on both sides, I bet.
Yeah.
Cool. Let's see. Crypto Class was asking, looking at the technicals on the weekly and monthly, March looks to be a month with high potential for a correction to 32. How do you think March will play out? I mean, so when it comes to timing based on like, you know, months or moon cycles or, you know, timing. I don't know. Whatever like scheduled time frame you want to come up with. Like I haven't found any quantifiable edge there. I mean, we talked about, you know, the March panic last year created buying opportunities. So cap gains tax, maybe people will harvest, you know, after that time period. But I don't know. I don't think of things in terms of the bull trend will be over on this date, unless there's like a unique scheduled thing. Like we knew back in 2017 when the CME futures were launching that was likely going to create a local top for a while. and it did. But it's very rare that you get something like that you can plan into the future and see a big pivot point. So
Yeah, great point.
yeah. Chris, about BTC's real value, the world is experiencing a lot of chaos now.
Crypto Class has a good question here.
Yeah.
How do you keep track of your progress and know you're on the right path when it comes to investing, besides just looking at your profit gains? Like, how do you know when you're, that you're making the right decisions and you're doing the right things?
I think that's a great question. For me, it's about, am I taking what I call yes trades? Regardless of the outcome, am I sticking to my plan? And am I taking what I believe are high probability setups and scenarios? Am I getting in when the on-chain data, the fundamental data, the market sentiment data, and the charts are all telling me it's a good buying time or a good selling time? Am I sizing my positions correctly, right? In the short term, there's randomness in your equity curve, right? You could wake up one day, especially in crypto, be down 20%, go to sleep for a week, wake up, be up 100%, right? So judging your success or lack thereof by short-term gains, I think, is kind of missing the forest through the trees. You really need to focus on, am I executing my strategy and am I sticking to my plan? That's what do you guys think?
Yeah, no, I do the same thing. Am I taking yes trades? Am I taking, am I in positions that I can sleep well at night, feeling comfortable in? That's kind of my gauge. And also, I also keep track of, are my winners bigger than my losers? Because we are all going to have losers. I mean, it's just part of the game, right? But am I managing my trades well enough to where I'm also seeing trends come to fruition? There have been a few positions that I've had to, wait. I've had to be patient. Am I being patient enough and allowing the thesis to come to life? And that takes, for me, that's really important for my progress. I also look at, is my size growing? Am I properly growing size as my account grows? Things like that kind of help me, in addition to just looking at gains by themselves.
Yeah, that's a good metric, right? Because as an investor, like, the goal is to constantly be pushing your comfort zone of size.
Yeah.
Right. Like if you're undersized and you're just playing with small amounts of money, you're maybe not going to compound it what you want to. Whereas if you get over aggressive and you size too big, you might end up taking a catastrophic loss that takes you out of the game completely, or just a deeper drawdown that takes you much longer to get out of.
Yeah, it's a delicate dance. And also, speaking on that, looking at the percentages of the different positions in your portfolio, are you managing how big positions are getting too, and how small positions are, and making sure that your allocation is proper, in addition, in relation to your sizing too, pulling out cash when you should be, things like that. So,
Trav?
Yeah, I mean, I think it's pretty much what you all said, like focusing on the process and the decision making, and just evaluating your recent investments and looking at, did I make the right decisions with the information I had at the time? Because like you said, you're going to have losers, and that's not necessarily like a failure if you sized it properly to manage risk, and you also, using the information you had at the time, made what you, in retrospect, still think is the right decision. So I look at a lot of my past investments. I do trade reviews every year to try to reassess that. Occasionally, when I do have a loss, I'll do like an investment memo where I kind of go through what went wrong, where I could improve. So just like, continuing to, like, maybe not every week or every month, but every so often, kind of review your investments, review your losers, and figure out like where in the process you can like continue to improve. And then beyond that, I mean, really it is like risk-adjusted returns and looking at like the growth of your portfolio over medium and long-term timeframes. Like, do you have too many drawdowns that are, that are significant drawdowns, or are you seeing a pretty steady, clean compounding growth curve? I mean, at the end of the day, that's what it's all about.
Yeah,
True.
So. And in crypto, because of the volatility, a lot of times it's not a smooth, easy growth curve, right? You've got to be able to stomach deep drawdowns, but that's how you make life-changing amounts of money, is going in heavy when everybody else is freaking out.
Yeah, for sure.
And on that note, I think we should go ahead and wrap it up. We've been going for over an hour. So any final thoughts or anything that you guys are looking forward to over the next week?
Well, the weather is starting to look pretty nice again, so
Boat season.
Whatever, it's still ski season. I don't want it to go away.
yeah, maybe get outdoors a little bit more over the next couple weeks. I hope.
Yep.
See.
Book some flights.
Yeah, why not?
Chris has been talking about just booking the cheapest flight to just sit in the airport.
Yeah. I love airports. I think the energy of airports is so awesome. And like, there's so many beautiful airports across the world. Like, I'm probably just going to take a month and just go sit in different airports and just people watch and, you know, be like, okay, are we back to normal now?
Which airport would you want to sit in all day?
John G.
Yeah. I love Singapore. Let's see. What are some other really nice airports?
I mean, Bangkok Airport's not bad.
Yeah.
It's a
They've got
busy
nice
one.
lounges. Yeah. Singapore's got that beautiful waterfall thing going on.
Changi is probably the best airport in the world
Yeah.
that I've been to. There's probably some really nice ones. Well, certainly there's some, you know.
Doha's
Yeah,
is crazy
I was gonna
nice.
say
Yeah.
Doha.
Doha's is nice.
Because it's new and it's obviously, you know, built with a lot of capital and opulence. And yeah, those are pretty nice.
What's your favorite U.S. airport?
Favorite U.S. airport? Well,
not LAX.
Yeah.
I can tell you that.
there's, you know, like Palm Springs, and there's some like smaller regional ones like that are really like nice and cool where you like step outside and it's just gorgeous.
Yeah.
And they're not overwhelming. But then in terms of large airports, maybe like, you know, maybe Portland or Seattle. I can't remember which one it is. They have a piano player. That one's always nice. You like step out and there's like a piano.
Yeah.
I don't know if they still have that. But
Yeah, it's weird. I can't think of any that like come to mind as like mind-blowing airports in the U.S.
yeah.
I like really efficient airports. I think Tampa's airport is really efficient
the
the way it
best.
works. Yeah.
Oh, really?
It's
Yeah,
an
the
amazing
best.
outline. Yeah.
Man, they did the airport well there.
Yeah.
That's awesome.
Yeah. It
Yeah.
just works.
I love that too. Yeah, the efficiency aspect. Because yeah, you go to LAX or LaGuardia or JFK, and it's a total nightmare.
Ugh.
And it's just every part of the experience is awful, and you're like, oh man, this is really what we have to show for.
Yeah. In general, Asian and Middle Eastern airlines and airports are just way better than the U.S. and Europe.
Yeah, it's funny to see the differences. Like in Europe, for instance, there's like sometimes it's just completely chaotic, and you have to get on a bus to go out to the runway. You know?
Yeah.
It's like,
Yeah.
what is going on? This is, you know, like you. I don't know.
I think the CEO of Ryanair like has some kind of like weird thing where he just loves making people miserable.
Yeah. Yes.
Cool.
And people still just fly them.
Yeah.
You know.
I mean, it's
they're
cheap,
happy to
you know?
fly them.
They're the Walmart of airlines.
Yeah.
Yeah.
They make a lot of money too.
That's
Yeah.
true.
Well,
Yeah, they've been
nickel and
successful.
dime.
Yeah. Awesome. All right, guys. Well, thank y'all for being here with us. Hope you enjoyed the show. We will be back next week. Unless we have another ice apocalypse where
let's hope
the
not.
state shuts down. But
No, submit questions, guys, on WeTalkMoney.com.
yep. Go to
Yeah.
WeTalkMoney.com. Subscribe to not only the YouTube channel, but also the podcast if you want to get the audio version. And yeah, we'll see you guys next week.
All right. Cheers.
Take care, guys.